Back to your host, Jim Freed.
All right, we're back, and I want to thank everybody for our real estate capital markets day today. We had market leader Charles Foschini on. Charles and I work together on a lot of great transactions. He's one of the best real estate capital markets guys I know. Thank you so much, Charles, Chris, and the rest of his team. And now we're on with Ed Cairo, Ed of the Mortgage Brothers. Ed is my partner on residential mortgage lending. Hey, Eddie, welcome back to the show. Great to see you.
Hey, Jim, nice to see you. Can you hear me?
Yeah, I can hear you and I can see you. Look to your left. I'm over here on the left. There you go. Anyway, so Ed, we're here with Ed Cairo. Ed, we were on the phone yesterday with one of the new lenders that you've got on board with your group of lenders. Now, first of all, let's talk a little bit about how the residential mortgage world works. You have more than one lender that you present these loans to, right?
Yes. As brokers, we have several lenders that we work with, and we're basically putting square peg in a square hole, where we have a lot of different varieties of investors that we can present the loans to, the loan package to.
Now, for the last 15 years, the Federal Reserve has artificially kept interest rates low as a reaction to the Lehman Brothers meltdown. They've been trying to get rid of all those low interest rates, and now with inflation coming, they've really cranked up the interest rates. That's basically put an end to the refi market that the mortgage brokerage business has been living off of for the last 10 years. What's taking its place?
Well, there's still a lot of purchase business right now, and the inventory is still a little bit low. It's getting a little better. There's a little bit more inventory on the market, but people still have to buy houses, and people will still buy houses, and there's ways to do it. I mean, there's it doesn't mean that because the rates are a little on the higher side that people can't buy houses. They may not qualify for the same house they did 3 months or 6 months ago, but certainly there's enough properties out there that they can find.
Not even the properties, but the loans themselves. The lenders are really hungry for loans now. They've created a whole bunch of new programs, and a lot of programs that were very fashionable many years ago are coming back into vogue. One of the things that the lending wholesale rep said yesterday that I found interesting that I hadn't heard in a long time is that people should focus on their monthly payment, not on the face rate. And then I talked to a friend of mine that bought his first home in 1980. He said throughout the 80s, he refinanced his mortgage every 3 years and kept lowering the rate and pulling out cash. Sounds to me like that's the new way to look at your home.
It is because, even though the rates are a little on the higher side, historically, they're not high at all. I mean, we got a little spoiled when they were 2 3/4 and 3%, and everybody thought that was the norm, which is not. Right now, I mean, they're in the sixes, high fives, sixes right now. Could they go higher? Possibly. But when you really look at it, and somebody wants to buy a property, there's a lot of factors that are involved. Appreciation in the property, number one. The fact that you can write off the interest. If you look at renting versus buying, all the rental prices have gone sky high, and they're going higher. So in a lot of cases, it really makes sense for people to buy the property. And one example would be, if somebody doesn't have the 20% to put down and they want to wait to come up with their 20% because they want to avoid PMI, as an example, mortgage insurance. So now they wait for 2 years until they get enough money to buy a house. They've missed the boat, because if the mortgage insurance costs a couple of, $200 a month, $2,400 a year, that's $5,000. Had they bought the $400,000 house 2 years ago, it's now worth $460,000. It just cost them $54,000 not to make that move. So there's a lot of reasons why, and a lot of it has to do with the payment. What payment are you most comfortable with? Because once you secure the asset, which would be, let's say, the property at this point, we can always refinance you later when the rates get better, which they will at some point.
So Ed, let's talk about the process for a minute. Somebody wants to buy a home. Not everybody, but a lot of people are out there competing with an all cash offer. How do you help people compete if they have an all cash offer?
Well, what we'll do is we'll take the person themselves, and instead of pre-qualifying them, we're going to qualify them. When their documents come in, obviously I look at the whole thing and I underwrite the file before it even starts, but I can run it through the Fannie Mae or Freddie Mac engine and get a complete approval, which will go to underwriting. Underwriting will underwrite the credit portion of the file, where all we need then is to plug in a contract, piece of property. They're already approved. So if I give them an approval, which is a DU approval, let's say, and then an underwriting approval showing that it went through underwriting, everything is fine except the fact we don't have a property yet, that's as close as you're going to get because they've got an approval at that point.
So, Ed, how long does it take to get an approval from filling out the original loan request? The 1003 is what the form is called, the government form that you have to fill out. From the day that the 1003 gets submitted, the process then is that they have to submit the supporting documentation, which borrower may not have directly readily available, but they should be able to get within a couple of days. So let's say now that you've got the application, you've got the form, the supporting documentation. How long does it take to quote somebody a loan and get them closed in today's marketplace?
If you're working with a broker like us, I mean, I can actually do it in 14 days. A lot of the problem that we've been having lately is trying to get the appraisals in quick because they're still dragging behind. But our process is usually 14 to 30 days. If you go to a retail bank, you're probably looking at 60, probably 30 to 60 if they can even get it closed.
Now, Ed, let's talk about the appraisal for a minute. There's been a problem with the appraisals. They've had a lot of problems keeping up with the increase in value. I'm sure that that's happened to you on a couple of files. How have you addressed that particular issue?
Well, I mean, when we deal with an appraiser, the biggest issue we have is that we're not sending the appraiser. It has to go from a third party. So when the appraiser goes out, everybody in the transaction has to be informed that there's no guarantee of anything. If the property comes in and it doesn't appraise, then there's a couple of things that we can do. I mean, one of the things would be that they can negotiate a lower price, which for the buyer, when it comes in low, it's actually good. It's not a bad thing because there's a way that they can actually get the property a little bit cheaper. Nowadays, the sellers aren't in charge like they were a couple of months ago. Their properties are starting to sit on the market a little bit longer. They're not demanding to waive the appraisals and the inspection periods and those types of things. So the buyer is really in a better position. And if it doesn't appraise, there's a good chance that the buyer is going to get the property for less money.
Wow, that's great news, actually.
Mm-hmm.
I'm writing these notes down, man.
Quite a lot.
Good stuff.
Yeah.
So then the good news is that mortgages are still readily available.
Mm-hmm. Oh, yeah.
That you can get them done quicker than a bank. That you've got the ability to get people a loan payment that's sort of similar to what they had before with a variety of different products that you're working with. Mm-hmm. And that there is a softer market for people to buy in. So this is all a bunch of good news.
It is good news. And, the other thing, too, is the sellers now are a little bit more willing to participate in the sale, where before they turned their eye and they just said, I want what I want, and that's the way it's going to be. As the properties start to sit on the market a little bit longer, which we're finding that they are, we can sometimes get the sellers to possibly give a credit to the buyer to buy down their rate a little bit, to get their payment where it needs to be. Because really, it's not about the interest rate. It's really about the payment. How much can the people afford? If they can secure this asset now compared to a year or two from now, which nobody really knows what will happen then, but as long as they can secure that asset, it's all about the payment. How much can they afford for their family? Because obviously everything else has been going up. If the seller wants to sell their house, rather than reducing the price of the house itself, sometimes I'll talk to the realtor and have them give a X amount of $5,000 credit, to the buyer's closing costs. And the buyer, in turn, what we'll do is we'll take that money and we'll buy the interest rate down. So instead of them being at 6%, maybe they're at 5.5%. So for the next 30 years, they're saving $200 a month or whatever the number is. When you think about it, it adds up. It's quite a bit.
Ed, I really do appreciate having you and your brothers there to support the efforts on the residential loans. I'm looking forward to continuing to reach out to the folks that I've been working with on the residential loans. Mm-hmm. What do you see going forward here from a product standpoint? You've been at this point before. You've seen that the public mortgage companies and the public banks that make these loans need to make mortgages, and new products are going to come out. Well, let's talk a little bit about the lady that was with us yesterday. What were some of the things about her programs that were different than others?
She had some really, really good programs. They're getting a little on the aggressive side. However, you have to realize too that with this environment, this rate environment, this rising rate environment we call it, the lenders are a little bit careful too, because whatever they're locking, they have to hold for X amount of time. They lock for 30 or 40 days. The market changes on them, they have to sell that loan. So a lot of them are only locking for 15 days as opposed to 30 days. And 15 days is tight. It's tough to close a loan. So a lot of times we'll have to go in with an average number, get the thing done as fast as we can. As soon as the appraisal comes in, we can then lock it and hopefully close it within that 15-day time frame. But the point of the matter is that what this particular lender was doing is, one is if you have a verification of employment from, let's say, a prospective boss, right, and we send it into the company, whatever is written on there, so they have base income, they have commission, they have bonus, we'll take that. We don't have to have a history of 3 or 4 years, which you're usually in Fannie Mae and Freddie Mac world, you have to have 2 and 3 years worth of that history. Where with this lender, they'll take whatever they're making. If they started, 4 months ago and then they made some commission and bonus, we'll actually take that. We don't have to actually average it out over the last 3 or 4 years. And those are the things that make people fall out from the Fannie and Freddie loans. The difference is the interest rate might be a little bit higher in these type of loans, but then again, it gets them the home, and if they secure the asset, we can always refinance them down the road. And when they do the numbers, they realize that it's not as bad as it really sounds.
So Ed, it's really about education, hand-holding, and being positive. But that sounds to me like the most important thing going is that you have the relationship with the lender, that you can ask for a favor, you can put somebody to the top of the pile. Yeah. That to me is another real value for working with a mortgage broker like you, Ed.
Yep, we have one particular one right now is a gentleman that has a house that's worth in excess of $6 million with no mortgage on it. And when he came to me, he was turned down by a couple of banks, and one of the local retail banks sent him into us, and he wanted to come face to face. He came into our office, and we sat down. And the bottom line was, when I started questioning him, what I realized is he has a business. His business is doing relatively well. He doesn't pay himself as much as he'd like to, and in order to qualify, turned out that he had X amount, up to do the numbers, but X amount of dollars in the bank in retirement savings, let's say. He had a lot of deposits in his business account, and he also had an apartment up in New York where he was making excess of $12,500 a month in rent. So when I combined all three of those, I was able to get an approval for this gentleman, and we were able to pull out $1.3 million for him. And nobody else would consider doing that. Only a broker can do that, because we're combining a lot of different ways of income streams to get this thing done.
Ed, do you have a couple minutes to do another segment, or you got to run out and close the loan?
No, I have a couple minutes. Sure.
That's
sure.
Awesome.
Okay, great. I hear one of the mortgage brothers in the background telling you exactly what to do. So we'll be back with Ed Cairo and the rest of the mortgage brothers right after this. We'll be listening to how Ed helps people put together their loan requests to get a loan when a bank can't do it.
Sounds
Mr.
good.
Mendoza, rock the house.
Back to your host, Jim Freed.
We're here with Ed Cairo. Ed is my partner in the residential mortgage business. Welcome back to the show, Ed.
Yep.
There he is.
Yes.
So, let's talk a little bit about why somebody would use a mortgage broker. What are the services that you would provide to somebody? And we talked a little bit about it before. You get them financed easier than the bank. You help them put their loan application together. Talk a little bit about how you help their application get to the top of the stack and get closed. We only got like 5 minutes left, so
Okay.
that gives you an understanding of what we're trying to do.
Yeah, well, one thing I can tell you, we're not order takers here. What we're doing is we are, taking the transaction from the beginning to the end, and we are walking these people through. I spend a lot of time with the client from the beginning, making sure they understand everything that they're doing before they get started. But really, we're very automated. So they'll take an application. They'll actually fill out their own application. I'll put all the documents together. We have several lenders that we can, submit the loan to. So what we'll do is we'll actually look at the documents and decide which one we think is the best rate, best service, all that, as fast as possible. We order appraisals right away. We order title right away, the insurance, we handle all those things. So that's the reason why we can get these loans closed in some cases in 2 weeks if needed. We try to have the realtors write up a 30-day contract, because that's the other problem is the way the market was prior to this. They were trying to come in with these 10-day mortgage approvals and all this nonsense, and it just doesn't happen, because by the time you get the appraisals, you can't control these third parties as best as you think you can. It's very difficult to do that. So you really have to have enough time to make sure that these people, the clients themselves, have enough time for their own transaction. But it doesn't mean that we can't go faster. So what we'll do is we'll get them clear to close a lot quicker. The realtors are very happy, and that's really how we got a referral business, because the realtors know that when they send it to us, we're all over it. I've got my brother Greg and my brother Paul, who do the processing and also the closing, and between the three of us, it's a well-oiled machine, and we're quick, and that's really how we get our business, because the realtors know that they can send a deal to us and it's going to get closed, and the clients also.
So Ed, tell me a little bit about the growth of the company. I know that you guys recently acquired a building.
Mm-hmm.
You continue to build the company. Just in general, I wanted to just thank you so much for everything, being on the team and allowing me to bring my clients to you. Last word to you, Ed. What do you think about the residential mortgage market going forward? What's a word that people can take with them?
What I think the residential mortgage market is still strong. It's going to be strong. I think a lot of people are getting scared away with the rates. I mean, yes, they're higher. We all understand. Everybody knows that. But there's ways to get around it. And again, as long as we can structure a deal where the payment is where the people need to be comfortably, we can always lower their overall cost later. And there's also a lot of refis. I mean, there's still refis out there now, because there's a lot of people that are finding themselves with the gas prices and the food prices, putting things on credit cards and all that. So the debts are high. So in a lot of cases, I can save people. There's a guy right now, I'm saving him $1,800 a month just on a refi, because we're restructuring his whole life, top to bottom. And we put him in a brand new program, and all his debt is paid off, and he's set now. And in the beginning, he was worried, because the first thing he said was, "Oh my God, the rate is 5.75%." And I said, well, that might be good, but you're paying 21% on everything else, and you still have debt. You still have overall debt, no matter how you look at it, whether it's on your house or whether it's on a credit card. A credit card's a 30-year payment. People don't realize when they pay the minimum. That's really what it is. So if we can knock all that out and put them at 6%, let's say, they're way ahead of the game. Plus, they're writing off the interest on that mortgage, which their effective borrowing rate could be in the fives, if you really think about it, if you factor in the write-off of the interest. So if as long as they can sit down and we can talk smack with them and really show them exactly what they can do, in a lot of cases it's still very strong. It's not as dire as people are saying it is.
Well, Ed, thank you so much for taking time out. I know it was a shock to the system, but now the market's adjusted.
Mm-hmm.
Look forward to continue to work with you and the Mortgage Brothers. I want to thank everybody for tuning into Freed on Business. I want to thank our sponsors, the University of Florida Center for Real Estate Studies, the Bergstrom Center, of course, Warren Henry Automotive. I want to thank you, our listeners. And I want to remind everybody we'll be on again live with a new show next Wednesday at noon. This is Jim Freed for Freed on Business. Remember, the person that wants to do something finds a way. The other finds an excuse. Now go out there and make it happen. God bless you. God bless the United States of America and the Mortgage Brothers, Ed. Everybody have a great weekend. Mr. Mendoza, it's all yours.